Most investors follow trends. Very few develop edge. This show focuses on something different: how serious operators build durable wealth in overlooked niches, starting with mobile home parks. We'll break down the strategy, underwriting, discipline, talk about the roadblocks, and the operational execution that'll make your capital aligned with long term returns. This isn't about chasing deals. It's about thinking like an allocator and executing like an operator. This is the Mobile Home Park Exchange. I can't control the market. I can control the asset. And that's where every operator should live. Now, what do I mean by that? Every serious real estate platform is running two clocks simultaneously. There's the operational clock and there's the liquidity clock. Now, the operational clock is measuring where the asset is building value. It's the occupancy that's improving. It's the cash flow that's growing. It's the infrastructure that's being upgraded. It's the infill that's advancing. It's the culture, the community culture taking hold. This is the clock that you can control. The liquidity clock that measures when you get your capital out. That's the refinance, the sales, the recapitalization. This clock is going to be heavily influenced by debt markets, interest rate environment, and buyer appetite. I mean, it's a clock that you don't control. And in a normal market, ideally, these clocks will run in sync, roughly, anyway. And in this market, they don't. And the operator who confuses the liquidity clock for a broken operational clock and makes decisions based on that because they're building to hit a number or an IRR return, they're going to damage the very asset that they're looking to protect. And we could see what's happened recently with S2 Capital. Scott Everett built a huge multi-family platform in the Southeast. He had 40,000 units in the Sun Belt. And he had a $400 million fund, which he raised, and all of his LPs are being completely wiped out. Now, it's been attributed, his quote that's been attributed to him is, fixed rate is for suckers. And, he built this fund around the thesis that he would acquire these properties with floating rate debt structure. And then he would be able to run out the liquidity clock, and made a bet that the market would shift, the debt market would shift in his favor. And that isn't investing. I mean, you're making a bet on something that you don't control. If you're betting on the operational clock, those are factors that you do control, because here's what happened. I mean, for him, rates didn't come down. Expenses went up. I mean, even though inflation is moderated, expenses are still higher. His rents went down across the portfolio. And so his operational foundation was not strong enough. The fact that rates stayed higher for longer, right now, investors are finding out that they've got a $400 million issue. But the single most important any operator or LP should be asking themselves right now isn't when is the liquidity event. It's which clock is slow. Is it the operational clock or the liquidity clock? Because those are two different things that you're looking to measure. When you're talking about the operational clock, right? You've got to look at what you're doing to build the asset. I mean, for us, that's making sure that every lot in the community has a permanent value creation there. Every time we infill a lot, we realize that there's a value creation in place, that we're adding value that at some point we're going to be able to pull out. That every time we convert a renter to an owner, every occupied lot that wasn't generating revenue before, that goes to the operational foundation that we're building. We want to make sure that the infrastructure is the capital going into the community, that might not immediately show up as NOI, but that will change the asset's trajectory over time, and more importantly, permanently. Because when you're improving underground utilities, you're taking away, long-term repairs and maintenance costs. When you're making road improvements or parking pad improvements, that's an initial upfront cost, but that's adding to the marketability of that community. You want to make sure that any improvement you're making along that infrastructure line, that's going to add to the long-term value. And then most importantly, that your cash flow growth is growing. Now, you may find that in the beginning, as you're ramping up or you're making those improvements, you're going to have more expenses on the front end, which would be offset down the road as those changes take hold. But you want to see the cash flow growth, and the recurring revenue is consistently growing. This is all on the operational clock. And these are factors that you as an operator can control. And the difference between being built around the operational clock rather than the liquidity clock is because you're not making a bet on the market. What you're making is an investment in yourself, in your platform, and in your systems that you have in place to create value over the long term. Now, that doesn't mean when you're in a situation or scenario that you're in now where, it's not as easy to secure favorable long-term debt, that you don't look for some creative avenues to create additional windfalls. And a lot of this helps when you're vertically integrated, because you can find maybe some non-conventional ways, whether it's a home sale that becomes a one-time revenue event, whether that's finding some ancillary operational revenue streams, whether it's utility reimbursements, whether it's in vending machines there that can create some opportunities for cash flow. These are different scenarios that you can run. Laundry machines or laundry centers. These are different scenarios that you can run that create some liquidity inside the asset that only comes if you're really focused and drilling down on how that operations work. So if you're out there, make sure your operator isn't building something shallow on the surface and built to hit a number or a quick IRR return metric. You have to ensure that they're building to create that long-term value in and around the asset. So if I was sitting on, or what I would tell an LP right now, especially because now we've heard, and I think we're going to see more of that. I think we've only started to see the beginning. A couple of syndicators, funds that have had some issues, especially because as rates have stayed elevated for longer. I know Brendan Turner a few weeks back, now S2. market cycles are real, right? They always have been. I mean, I've been in this and I've had the fortunate of being in the real estate business for 25, 26 years now. And you've seen all types of cycles that have happened. And when you build or you look to execute inside of just that cycle, so you're trying to catch the momentum of what's happening inside that cycle, that's where mistakes get made. That's where people end up either overpaying or overplaying their hand, because the market can turn or stay or not shift the way that you anticipate. And that puts you in a position where if you're trying to time something that you don't control, that can be very, very painful. But if you're looking at the operational timeline, right? And that's the key. Is the business plan, is the operational business plan, not the liquidity events, is the operational business plan on track? That's really the key focus, because at some point in time, the liquidity markets, the liquidity clock will change, right? And that usually changes a lot faster than the operational clock will, right? That could run a lot faster. But if you build not around your liquidity assumptions, not around whether I'm going to get better floating rate debt, right? But if you build around how do I build performance around the asset, then you know that that value is intrinsic, it's embedded, and it's there. So, like I said at the top, I can't control the asset. I take that back. I can't control the market, right? The one thing I can control is the asset. And if you operate with that, right? If you operate with controlling that asset, working on the variables that you can control, right? Then the asset doesn't stop building. So know, if you're looking at your investment, know which clock is slow, right? And make sure that you're viewing this from the lens of where are we operationally and where are we in the liquidity clock, right? The operational clock is so much more important. That's where you need to build, because at some point in time, the liquidity markets, the debt markets, that changes. But if you're not where you need to be operationally, it doesn't matter. You're just betting on something that you can't control. It's been another episode of the Mobile Home Park Exchange podcast with Frank Rizzo. Until next time, everyone, happy investing.